Cryptocurrency capital gains taxes are becoming a point of interest for governments, tax organizations. Did you buy, sell, use, or trade crypto? If so, you may owe taxes if you're a U.S. taxpayer. How many Bitcoin investors are not up to speed with the IRS crackdown? Millions? Probably. Coinbase alone has 35 million customer accounts. The number of taxpayers reporting crypto trades was, until recently, in the hundreds. If it was once hard to plead ignorance of tax laws regarding crypto, it's now impossible. The new Form 1040 demands that taxpayers say whether or not they own any virtual currencies. The yes, no question parallels the one that was implemented years ago on offshore investment accounts and led to nasty treatment of people who lied. Welcome to Savvy Finance, where we post videos to get you ahead in your investments and finances. We would greatly appreciate if you like this video and leave your opinion at the end of the video in the comments section. Don Fort, the chief of the IRS Criminal Investigation Unit, recently spoke on a tax conference panel and discussed at length how cryptocurrency is becoming a new area of enforcement. Other events like the IRS Coinbase summons and the IRS warning sent to tax filers is a clear indicator the U.S. crypto traders should be looking closer at the tax implications of their investments. We get it, paying taxes on Bitcoin and other crypto can be confusing. While we can't give tax advice, we want you to maximize your crypto gains. There's a lot of conflicting content out there, but make no mistake, you are required to report gains and losses on each transaction, or when you earn cryptocurrency, even if the gain or loss is not material. The IRS holds you responsible for reporting all income and transactions whether you receive a tax form from a crypto exchange or not. Many exchanges make transaction history available for this purpose. One quick note if you're a non-US investor is that taxes on crypto are treated differently country to country. Buying and selling crypto is taxable because the IRS identifies crypto as property, not currency. As a result, tax rules that apply to property, but not real estate tax rules, transactions, like selling collectible coins or vintage cars that can appreciate in value, also apply to Bitcoin, Ethereum, and other cryptocurrencies. The IRS isn't kidding around. Failure to report income, including income from the sale of crypto, could result in IRS levying penalties, starting with 2019 tax returns. The IRS requires you to answer yes or no to a question about whether you had any crypto transactions during the year. Please consult with a tax planning professional regarding your individual reporting obligations. With this increased scrutiny comes the question, how can I minimize my crypto tax liability while staying in the good graces of the IRS? Here are 3 strategies you can use to minimize your crypto tax liabilities. 1. Be a long-term investor. Cryptocurrency is treated as property by the IRS. Just like stocks, bonds, and other forms of personal property, you incur a capital gain when you sell property for more than you acquired it for. The government taxes these capital gains differently depending on how long you held the investment. Because the government wants to incentivize long-term investing, the capital gains tax rate is less for investments that are held for more than a year, and more for investments that are held for less than a year. This means that if you bought Bitcoin, held it for a month, and then sold it, your capital gains tax rate would be higher than if you waited to sell it a year later, minimizing your investment's returns. Some may argue, crypto is so volatile, it doesn't make sense for me to hold my investment for that long. This is a very fair point. Because of the volatility present in the crypto markets, it may make sense for some investors to seek short-term gains. However, what if there was a way to cash out now but still benefit from the longer-term capital gains tax rate? This is where borrowing against your crypto holding can really pay off and minimize your tax liability. Selling crypto is a taxable event. Exchanging crypto for crypto is a taxable event. But borrowing money against your crypto is not a taxable event. This makes lenders like BlockFi a great way to gain access to USD without having to sell your crypto investments. Let's say you bought $1,000 of Bitcoin in June of 2017 and saw that investment grow to $30,000. You would face a $29,000 capital gain if you cash out now. Depending on your yearly income, for this example, let's say it is $60,000, you would face a short-term capital gains tax on that gain of 25% and would owe $7,250 to the government. Now let's say you borrowed $30,000 using your Bitcoin as collateral. As part of that loan, you will pay interest monthly. Now you receive that same $30,000 that you would have from selling your Bitcoin. But now you will have the benefit of receiving the long-term capital gains tax rate rather than the more expensive short-term one. Instead of a 25% tax rate, you would only pay a 15% rate on that same capital gain. You pay $4,350 instead of $7,250. Obviously, this can have a much more dramatic effect when capital gains are substantial. Additionally, you may have the ability to write off the interest you paid on a crypto-backed loan, reducing your overall tax liability. 2. Keep a detailed record of your crypto transactions. To ensure that you are paying the correct amount of taxes on your crypto capital gains, you should keep detailed records of every crypto transaction that you participate in over the year. The data you need to collect for these records includes the date you acquired the crypto, the dollar value, the date sold, and the proceeds from the sale. You need all of this data to properly calculate your cost basis and to report your gains. If you haven't been keeping a detailed record of your crypto transactions, it could save you a significant amount of time to use crypto tax software that automatically calculates your cost basis and capital gains liability for you. 3. Work with a tax professional. While calculating your capital gains taxes from your crypto activity is actually quite straightforward. Some traders are doing much more than just high-volume trading. If your situation is complicated, leveraging a knowledgeable crypto tax accountant can often save you money on your tax bill. There are specific tax rules and exceptions within the crypto space that professionals can utilize to help you save money. At the end of the day, it is a good thing that you have a capital gain liability. It means you made money. However, it is important to be responsible and properly file your gains while simultaneously minimizing your tax liability. 4. Tax loss harvesting. Cryptocurrencies allow you to harvest tax losses aggressively, leading to higher savings, which you can reinvest in your portfolio. Since cryptocurrencies are treated as property as opposed to stocks and securities, they are not subject to wash sale rules. This allows you to sell your loss positions just to harvest losses for tax purposes and quickly get back into the same position without having to wait 30 days. These harvested losses can be used to offset your crypto and other capital gains. What is your opinion on paying tax on crypto gains? Are you making plans to pay yours soon, or you will rather hodl? Till our next video, stay savvy.